Good afternoon, everyone. Welcome to the monthly session of Netra, early warning and signals through charts. In today's day and age, there is a plethora of information that we have available to us. What we need actually is something that we can cut out the noise and make sense of what's useful. Our initiative, Netra, does exactly that for you. It is a collection of charts that provide a more scientific and data-based approach to understanding macros. Our speaker, Mr. Sahil Kapoor, who is also the brain behind Netra, has over 2 decades of experience across asset class and businesses. At DSP, he heads the product team and is also the market strategist. Before I hand over the call to Sahil, I would just like to make one point. There is a Q&A tab at your screens. If you have any questions, even during the sessions, please enter that question there. We will take them all at the end of the session. Sahil, over to you.
Thank you, Niyati. Good evening, everyone, and welcome to the call today. And so, as you know, in the first week of March, we released this month's Netra. We come out with the report every 5th of the month. And if it's a non-working day, we try to, prepone it a day. But and there are, permanent links on our website on dspim.com where you can go and see all the previous versions of Netra. And through this report, as Niyati highlighted, our endeavor is to get you insights which are important and which can make a difference to your investment journey and can help you take good decisions. So this month's Netra specifically focuses on 2 aspects only. One is where are we in our own investment journey? For example, in India, what are the key changes happening? And we've tried to look at some long-term changes. And second and more important is we've tried to touch the oil market. And why oil? Because this is exactly now 1 year since the Russia-Ukraine war broke out. And there were a number of ideas, charts, and inputs that we've discussed over the year. So I thought it's a good time to reflect on them and think about them and see the future course for markets where the data is telling us where are oil prices headed and how to look at them. So I'll start today with the insights on these 2 aspects. And as you know that in India, there has been a longish discussion now that a lot of investment flows from China should head towards India. And I'm going to probably talk about a few data points which are not there on this slide, but I will try and touch most of these data points and make them relevant for China and India comparison. So as you know that over the last 20-25 years, China has attracted huge amount of capital. And so I looked at the overall portfolio flows or the portfolio investment. In India, we colloquially call them FI investments and the like. If you look at that number on the balance of payment, China has received about $1.4 trillion in portfolio investments in the last 20-25 years. Since I think about the data that I picked up was for about 25 years. And India has got about $330 billion. And if you look at this data collectively, the Chinese number is about 4x of India. And it's very obvious that China will get larger flows because the growth has been much more bigger and stronger. For example, I'll tell you one data point that in about 1987, both China and India had very similar GDP, about $257 billion. Both had the same GDP actually in one of those years. And since then, the growth has been significantly different. China has grown at a very fast pace. It is now at about $16 trillion in GDP, $18 trillion in GDP, and India is at about $3.5 trillion. But what is important is that after growing at a very fast pace and attracting a lot of capital, China has not delivered returns which are significantly superior, right? So if you look at the headline index, if you look at Shanghai Composite Index, and the Nifty index, and if you take the US dollar return, not the local currency return, which is very different, but the US dollar return, which accrues to the international investor, you will see that India has given 6.6% excess return over China during this period. although we have received much less capital. But two very important distinctions which I want to make, which is not there on the chart. One is that foreigners hold about $3.5 trillion worth of assets in Chinese markets, okay, which is a very large number. But when you look at it from China perspective, it is still not very large, right? The GDP is much larger at about 18 trillion, right? But an FI holding in China is much smaller. If you look at only stocks, which is mainland Chinese stocks, not Hong Kong stocks, but only mainland China stocks, FIs hold between 5 to 6% of equity only, okay? But when it comes to India, FIs hold a much larger pie at about 18% of the overall, free float and overall market cap, not just free float. And in India, they hold about $440 billion worth of equities, right? So FIs have a larger share in India. And they have also made more returns in India. You can see that the returns are much higher. Now, what are the implications? First implication is that going ahead, there is possibly a reason to believe that FIs will be more inclined to look at India more seriously. Whether it will come at cost of China or not, I'm still not sure. But there is a possibility that it could, right? They could look at investing a little more in India. But for that, India has to continue to deliver stronger earnings growth, which it has done over the last 20-25 years, better ROEs. And when you look at the MSCI basket, India has delivered better returns, better earnings growth, better stability, and even better stability of earnings. So if that remains the case, which if you assume that could be the case, then possibly India could give higher returns. Second and more important point, if you look at India's weightage, prior to COVID, our MSCI basket weight, our overall mix in the weightage for MSCI was about 8.5-9%. Today, it is getting closer to 16%, right? So there is a clear distinction. Our weight has gone up. And second and more important point is that this large chunk of investment which has flown to China is now looking at more opportunities. And if India is able to deliver that kind of growth and stability, which it has historically, then possibly we'll get a share of that, larger share of the FI flows. And the idea is if that comes to fruition, then possibly India will see better performance. Apart from the COVID year, India has not really seen very large FI inflows for the last few years, and possibly that could change. So key takeaway from this chart is that A, India has delivered returns. B, there is reason for that return because of better earnings growth and quality of earnings. And C, in the future, India could receive higher share, largely because these factors could repeat. The second chart, which I'm talking about today, is the investments upsurge. And what is investment? This is investment in fixed assets. So there is this bar chart here, which gives you GFCF, which is in absolute numbers. So this is in absolute dollar, gross fixed capital formation. And this is a chart which was, which became a little famous after we released this month's Netra. And a lot of people ask me whether this is adjusted for inflation. It is not adjusted for inflation. And I'll tell you the reason why. You could, of course, look at three more cuts of this data. One is as a percentage of GDP, which is a more logical number. When you look at it from a year-on-year perspective, you could also look at the percentage change. Again, a more logical number to look at. And third is how does this stack up when you adjust it for inflation, right? When you adjust it for inflation, you will see that there will be some change in historical numbers. They will start looking a little larger, but the essence of data will not get lost. But let me tell you why am I using absolute numbers and what does this mean? First is this is investments to GDP. That means all the fixed asset creation happening in the country. And who does this fixed asset creation? Who spends this money? So largely three entities. One is the government of India. Second is private enterprise or the corporations. And third is the households, people like you and me, right? All three put together do these investments. It is not only any single entity. And when you combine them together, you will see that that number will show up as GFCF, right? And the largest share in the overall investment is households at about 47-48%. Households contribute a very large percentage of these investments in the form of what we call dwelling units in economics, nothing but houses that they create, right? That is one of the biggest investments. The other being the capex done by corporations to further their business. For example, somebody putting a cement plant or a petrochemical plant or any other capex that the corporates do. And third form is expenditure done by the government, like, for example, creation of road infrastructure, airports, railways, highways. All of these, come into this number. Now, the point is that why this number now, and what is the interpretation? So, since independence, India has spent about $14 trillion. How does this $14 trillion number come about? So, if you take annual gross fixed capital formation every year that we do, and just add that number over the last 75 years, you will find that number total up to $14 trillion. And if you look at just the statistical data, out of that 14 trillion, 7 trillion happened in the last 9-10 years, right? And why did I take up 7 trillion? Because it is just 50% and it gives you a more logical number to look at when you remember that number, right? And second and more important aspect is, why does it become important to talk about now? The reason is that now we have started to do about $1 trillion annually in fixed investments or investments to GDP. $1 trillion, why is it an important number? If you do a pecking order of global, countries, which countries spend $1 trillion in a year on fixed investments? So the list is very, very short. First is, at the top is, of course, China, which spends about $12 trillion every year in fixed investments. 12, right? We are talking about one for India. US spends about $5.5 trillion each year, right? So these two are the bigger ones globally. And third comes Japan at $1.2 trillion. And then there is Germany, which is at $950 billion. And India was also at $950 billion last year, slightly ahead of Russia if you take, of Germany if you take trailing 12 months. This year, which is in FY24, India will become number 4, right? The fourth number in terms of pecking order, who does $1 trillion in annual gross fixed capital formation? And therefore, this number becomes very, very important. Second distinction, there are very few countries where these investments happen outside of the energy sector. If you look at all these top 3 countries which spend money on creating fixed assets, many of them contribute between 25 to 30% to the energy sector. They have very large energy sectors and they spend a lot of money in capex in that sector. In India, it is very, very small. So now I'll tell you 2-3 important key takeaways. First is that because we're going to spend $1 trillion each year, we will have a very large scale. It's not very easy for many other countries to spend this kind of money on fixed assets, which India will now because of this size and scale where we have reached. Secondly, we'll be spending this money largely outside of the energy sector because our energy sector is still relatively much smaller in comparison to many other large countries which have this kind of a number, which means that sectors involved in housing construction, infrastructure creation, and the ancillary sectors, they will possibly benefit a lot more than what they do in similar expenditure in other countries. So the key takeaway is that this is going to be a very large number, and we are already amidst a capex reviving cycle, and this number reinforces that over the next 7 to 10 years, we'll see that this number will become much larger and help the sector do very, very well, right? And again, one very important key aspect which I want to highlight through this data, that this number in the last 10 years was not very high. Although I have written that 7 trillion, 50% of 14 trillion happened in the last 9 years. But when you look at it from 2011 onwards, India's investment was in a winter period. Up until COVID, investments was in the slow lane, and then it picked up significantly, and now we are starting that investments to GDP number has started to rise towards 30% plus, right? So there is a likelihood that over the next 10 years, this cycle could surprise upwards, and it's quite likely. And that's why this chart and this data is very, very important and important to study. The next slide is on corporate India's deleveraging. We've heard this time and again, and there have been a lot of debates that corporate India actually hasn't deleveraged. A lot of people believe that deleveraging hasn't happened, but we looked at the numbers. So we took out BSE 500 data. And if you look at the BSE 500 numbers from FY20, which is the pre-COVID year, the corporate debt, net debt, adjusted for cash, was about 12.5 or 12 quarters of 12.25 lakh crores, which was the total debt. It has fallen to about 8 lakh crore. So very clear sign of deleveraging, and the net debt to EBITDA has fallen from 1.5, which was very high pre-COVID, to 0.67, which is a very, very sound number. Although not very low, but it is quite significantly low, which tells you that there is a deleveraging cycle which has happened. Now, why this is important? As I showed you in the last slide, that we could do a very large Capex number, looking at where we are in terms of size. Corporates have deleveraged. So if you see, the corporate profitability has gone through the roof, right? If you look at corporate earnings, sorry. So in the last 2 years, Nifty corporate earnings has really grown, right? FY21, the EPS for Nifty was upwards of 25%. And many sectors which are Capex heavy, there's a significant cut in their debt, and they paid off debt and repaired their balance sheet significantly. Now, the question is that when corporates get a lot of money in their hands, or they make a lot of profit, what do they do with these profits? So in the first cycle, what they do is that they pay down debt. They will repay debt, but eventually what they will do is that they will do Capex, because most businesses are in the business of doing business, right? So they are not in the business of saving money perpetually. They can do that if they are cash machines, for example, an IT company which does not need to invest more. But many other businesses have to invest, right? And which means that if net debt to EBITDA has gone down and there has been a deleveraging cycle and corporate profitability is maintained, it's quite natural that corporates will go and do another round of expenditure. So this data, in conjunction with the last slide, clearly tells you that if there is a Capex pickup, which appears to be the case top-down, corporate balance sheets are now healthy enough to take the Capex cycle forward. And that's why I think these two clearly tells you that sectors which are focused on engineering, infrastructure, and core sectors, they are probably here for many more years. And there is a possibility that market participants are possibly underappreciating this cycle. The third one is also actually linked to some extent, which is the banking sector. And if you look at the banking sector, this has got 3 charts. And what I've done is that I've put a few numbers. These are some of the numbers which I've also shared in the past in previous instances of Netra. And if you look at the GNPA ratio, which is in the black, if you take the upper segment, the bars which are in black. So if you see in FY18, the GNPA ratio was 11.22% and has now fallen to about 4.5% and possibly going even lower. And NNPA has fallen to about 2-decade lows. The provision coverage ratio, or the ratio in which how much bad loans are covered, that is also approaching 75%, which is again a very, very healthy indicator of the identification of stress and providing for it. And if you look at fresh slippages, that means how many fresh loans are slipping into NPAs, that ratio is also now falling, right? In totality, that number is also falling. And third aspect is your credit growth is still very strong. Deposit growth is picking up. So if you look at all these indicators and put them together, you get a sense that the banking sector is in a very good shape, right? And it has possibly seen the worst cycle already, and it is now moving towards improvement. So if you imagine a pendulum, in FY18, the pendulum was at one extreme, which is the worst possible point for banking, where everything was going wrong, and now it is at the middle and swinging towards the best extreme. It is going in the other way around. So it is cyclical, and maybe few years from now we'll again be talking about NPAs and other issues with the bank, but those issues will happen in the future when there will be rampant lending and the credits will come into picture. But for now, we are far away from that cycle, and it appears that banking will be a very supportive sector for the market, and also ties very well to the last two slides I showed you, right? The financial sector or lenders per se are also in a very good shape to support the Capex recovery. And this is not only about Capex recovery, they are also here to lend to consumers per se, right? So in totality, both of them go together. So lenders, again, banking appears to be a very, very good sector. Next is the India's external situation, and I think FY23 or April 22 to March 23, there were a lot of concerns. So if you look at FY23 bar, so what this bar shows you is India's current account deficit as a percentage of GDP, and it was 2.5 minus 2.5%. We were losing 2.5% of GDP on current account. And why did this happen? Very, very large bill for oil. Oil prices went through the roof. Calendar year 22 was one of the only few years where the average for the year was $100, close to $100. I think it has happened only once or twice earlier, or maybe never. I think even in 2013, I remember the average came to about 97 or something like that. So even when oil prices have gone up, they struggle to be there and then they come down. But nonetheless, $100 oil was a problem for India. It has come off somewhat. So we looked at what could happen in FY24, and we looked at three scenarios. Let's say if oil is at $80, our current account deficit will come down from 2.5% to 1.3%. So there will be some stability. If oil is at $60, it will be 0.5%, which is a very, very positive development for India, right? And which of these aspects will be true, we don't know. These are just conjectures. I will talk about oil in the second half, and I believe that there is a case for oil to be at $60. And if that case comes to realization, if that appears on the screen, then possibly this could play out for India. And why this shrinking of account deficit is happening, it's not just oil, right? What has happened is that our services surplus, the services inflow that we have, has gone up significantly. So just to give you a comparison, in the last cycle when we were at $100 oil in 2011 to 2013, our services surplus was $55 billion. Very small. Today, that service surplus is pushing towards $125, $130 billion, right? And that is what is giving us cushion. Can this services surplus come down because oil is coming down? Because I think both are linked. A lot of people will believe that oil prices will fall if there is a global recession and slowdown, and therefore even our service surplus will shrink, right? And we've seen in the past that service surplus is much more sticky. Even if it falls, it doesn't fall like oil prices or the bill that gets cut for India in terms of oil imports. So it is not as sensitive. So eventually, I believe that in FY24, India's external situation could be much more healthy. And that could be the reason why in FY24, you will have more reasons to, more RBI could have more reasons to have a more stable currency, and therefore has more option to exercise better monetary policy in terms of taking a clue from the Fed or having its own say for setting interest rates. So as we stand today, I think RBI has probably done enough. Should it continue to follow the Fed? From a prescription perspective, I don't think it's very necessary. Although they will have to take a very, very cautious call in terms of how far can they digress from Fed, if at all they decide. Right now, it has not decided to do so. It is still following the Fed, and probably they are not trying to anticipate or stop raising rates before the Fed does. And I think in the next 1 or 2 months, this situation is very fluid. It is likely to change because US economy and the Federal Reserve is only one data point away from changing its opinion. So we have to be very clear in terms of how the Fed perceives data. But it's very clear FY24, India's external situation will be much better, and it gives some elbow room to the RBI. The next is S&P 500 data. Although this data I've put not for S&P 500, but for telling you that equity markets usually do. This is just dumb data. What these bar represents, both the bars up and down are for S&P 500 yearly change. So if you take calendar year percentage change, this is what it is. And if you look at the last 100-year data history, there are 4 instances where S&P 500 has fallen for 2 or more consecutive years. That means if it falls in 1 year, then it again falls in the next year, and so on and so forth, right? So there are only 4 instances. So if you look at this instance, 4 years in a row it fell. This is the depression. And then after the recovery also, during the World War II, it fell thrice. 3 years consecutively, and in the oil shock of 1970, it fell twice, right? And then in the dot-com burst period, it fell thrice, 3 consecutive years. So only 4 instances earlier. Now we have another instance where 2022 calendar year S&P 500 was negative. If it clocks in 1 more negative year this year, then possibly this will be the 5th instance, right, where 2 consecutive years are negative or more, which is not very common. So it's very clear that even if we have a very large drawdown year, it may not be as bad as 2022. Secondly, what we've seen is that market took a lot of beating last year. In US, it saw its valuation come down. The multiples have got squeezed. So the key takeaway from this slide is that in the next 6 months, US markets could remain in a sideways consolidation. You could see that markets go up and down and eventually don't do much for some more time. But the possibility that we'll have another 20% plus bear market fall from current levels, it's a little remote, right? We can never say never, but it does appear that we could have a large range consolidation in US. Range could be as high as 10%. It could fall and rise, but largely I think another 6 months of consolidation is pending in US because economy is yet to slow down. At 5% short-term yields, it will be very difficult for US economy to continue to exhibit strength, right? So it's very clear that it's not going to happen. It can happen for a month or 2. It's very difficult to continue. What should be the strategy? We believe that US markets not doing so well or being in consolidation historically has coincided with very good outcomes for emerging markets. Although it sounds funny, but that's been the case. If you go back in history and check, you'll see that sideways US markets are one of the best news for emerging markets, and that could play out positively for India for the reasons which I spoke about in the slide number 1. I'll now get to the next section, which is on oil, where I'll spend some shorter time, but I'll give you some insights which are important. And I've tried to review some of the stuff that we've gone through during the year. So if you look at the left side, So if you remember, 24th Feb 2022 was the year when the day when Russia-Ukraine war was it actually started. The hostilities started, and that month was the peak for oil prices. They tried to visit that, but eventually tumbled. And that was also the peak for the calendar spread for crude oil to touch a lifetime high. So if you look at crude oil price, future price, 1 month minus 12 month, which is the spread. Why is this spread important? This is the calendar spread, which tells you whether crude oil is in backwardation or in contango, right? And I have gone through this concept on many calls. Backwardation is a abnormal market. It tells you that market is in a very bullish phase, and this was the peak of that bullishness. And since then, you can see that bullishness has been given up completely. This blue line has gone down. In fact, at the end of December, it actually turned into contango. Right now, it's in a very small backwardation. It's very clear that crude market has given one simple verdict, that supply for crude oil was not hit during the Russia-Ukraine crisis. That was the expectation, and those of you who attended the call that we did on 25th Feb 2022, we highlighted that it's very difficult for this to happen, and the supply chain will get disrupted, but very difficult for the oil market to get substituted and see that Russian oil goes out of the market. So things have played out differently. What has happened is something very different than what Street anticipated, right? The supply for crude oil products got hit significantly. So if you look at the right-hand side, this is the spread for crude oil products. So this is the diesel spread, the petroleum spread. These are the spreads for Singapore and US WTI 3-to-1 crack spread and diesel WTI crack spread. If you look at all the three spreads, they rose significantly. That means, what does this mean? The refining capacity for oil was at risk. That means production of petrol and diesel became very scarce, and that is what has kept the oil market very tight. People were not able to get their hands on petroleum products, not oil so much. Oil was still available, supply chains got reset, but people were still not able to get petrol and diesel, and that is what is getting reflected. And these spreads are still elevated. They have still not come down. They continue to remain elevated. Although the most recent data that I've looked at this morning, these spreads have come down even further. They have come down below the lows that we saw in the last 6 months, but they still remain quite elevated, right? And third chart, if you see here, inventory buildup for oil. Many of you who have not seen this chart will be surprised to know that crude oil inventory in US is now higher than the last 5-year average. There is more oil in inventory in US than there was in the last 5 years on an average, right? This has changed only in the last 1 month, from being less than average to more than average. That has been the uptick, right? So, and that's the case in most countries today. In fact, the most recent data that I read about China, their crude oil demand is much lower in last few days. On some days, it was less than 10 million barrels a day in terms of import demand, which is usually hitting 11 and a half, right? And fourth chart is for products. So this is the inventory picture for US gasoline. You can see it is still below 5-year average. So products are still scarce. Production capacity or refining capacity is now coming online in the next 6 months. And this is my conjecture that even the crude oil product inventory will be above average because of the of refineries which are coming online, specifically in China, in India, and many other parts of the world. You will see that this number will improve significantly. And therefore, as I said in chart number 2, there is a likelihood that oil will slip to $60-65 range from the current $75 to $85 range. So there will be a $15 downshift in crude oil prices. And this, I think, is not priced in the market at all, specifically in India, neither in the rupee or interest rates or for the inflation picture. And this, I think, will probably play out in the next 6 months to 1 year. And this could be a reason for things to change, and markets to anticipate this change will require prices to actually start trading lower. What could be the clue? If Brent crude starts to trade below $78, you will clearly see that this hypothesis will start getting traction and a lot of eyeballs. And it's already there in the data. There is no denying the fact that things are changing, that oil should head lower. Right. Next is on oil and gas capex. And last 2-3 years, I've tried to put this data in different forums. In one of the Netra in August 22, I had highlighted how demand for oil has been subdued for 20 years, ex of India and China. And there has been a lot of debate that enough capex is not happening. So in 2022, there was a $499 billion oil and gas upstream capex. What is oil and gas upstream? Upstream is all the companies which are in search for oil, which is the exploration part of oil and extraction of oil from the ground, right? So all these companies who are involved in these operations are called upstream companies. They have spent about $500 billion in 2022, which is an 8-year high. And these were the data points from which the whole street has always compared the oil capex number. These 4 years, they've been set as benchmark for higher oil prices. 2011, 12, 13, 14. These were the 4 years when crude oil was $100, right? And there was a massive capex which happened for oil, which kept the prices low for a very long time. And the year oil prices go back to $100, capex comes back, right? So there is no surprise if there is higher commodity price, higher supply will follow. And this is the economics rule 101. You can delay it, but you can't deny it, right? And many other oil majors have now started talking about more oil capex. And if that remains the case, then possibly you will see it translate to higher supply also. But mind you, please remember that the demand is still not rising as fast. And I'll show you a chart for that. This is the chart which tells you a little bit of little bit about oil demand. If you take 100, if you take oil demand in absolute term, let's say the full oil demand is 100. Out of that, about 49.3%, or let's say half of oil demand comes for road transportation. Okay, so this is world oil final consumption. Okay, so road transportation commands half of oil demand, oil consumption globally. And within the road, the largest chunk comes from cars and trucks. And if you look at these two automobiles, there are the two largest markets are US and China. Okay, these two markets are the largest markets for automobiles in the world. And if you see, both the markets have seen the peak for their auto sales. For example, China saw the peak in 2018. US saw the peak in 2016. And since then, their annual sales for automobiles have been lower from that year onwards. It has not grown, right? So now look at this from two angles. One is that the biggest consumer of oil on each year, which is the automobiles or the vehicles, the total number of those vehicles are gradually tapering off or plateauing because the new vehicles which are being sold are less in number, right? And second and more important point, from 2016, where the EV penetration rate was 1%, that rate globally has gone up to about 10%. In some of these markets, it has gone up as high as 30%. That means the new vehicles which are being sold incrementally, EVs are taking share away from the IC engine or the internal combustion engine, which uses crude oil products, right? So which means that half of the crude oil market is dying. Okay, which also means that do you actually need the amount of capex that you required in the last cycle? Okay, The answer to that is no, and which means that demand side dynamics for oil are bad, and they will keep on becoming worse as the time progresses. So for the next few years, it is going to be a very difficult path for oil, both from a demand and supply side. Supply side, we are seeing a lot of changes happening. It's not at all stable. But from the demand side, also there are a number of changes happening. They are again not very stable. And if you add very high interest rates in the Western markets today, and they're trying to slow down the economy, plus China talking only about 5% growth, you will see that it will be very difficult for oil demand to sustain at the levels that it has post-COVID, at 101, 102 million barrels a day. It will be very difficult for oil demand to stay, which means it will not be very tough for oil to down move by $10 to $15. And that is what I expect. And that I think has not been priced by the market. This chart is again one more signal by the commodity markets. The whole curve. So what I've done is I've taken all commodities and looked at their future curves and created one single index. And if you see this blue line, whenever it slips below zero, you will see that inflation conditions in that time, in that phase, are more benign. It doesn't become very, very unnerving, right? And again, we are seeing that commodity prices have started to slip below this threshold, which means that the component in inflation which comes from commodities will start to help inflation come down rather than go up, right? And this will have a soothing impact on inflation. It may not sound very credible today, with all the news in the last 1 month of sticky numbers and Fed again starting to talk about higher rate hikes. But this is what the data says. This is how the real hard data for commodities is printing, and it is telling you that they are heading lower. Whether that happens in the month of Jan or Feb does not matter, but over a 6 months period, it will happen, right? And this is what the data is showing. And eventually, this means that both inflation and growth both are slowing down, and it will have a rub-off on global markets, global equity markets, and global commodity markets along with inflation. And that will have an impact on central banks in reducing interest rates. So this was the last slide, and I will end here with this slide on infodemic. There is a lot of information out there, but if you are able to gather the best of them, you will be able to eliminate those parts which you don't need to consume. So with this, I will stop here.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.